7 Investment Rules You Can Follow. This new article will share some rules for investment goals, especially for new investors. 1. Do not borrow money to start investing. Borrowing money is obligatory to pay interest, and especially when you are just starting out, it is very difficult to earn money paying interest to them, whether you invest that money to run a business, buy stocks, bonds. Anyway, you should understand that investing is usually focused on long-term goals to get a lot of profit, and there is a very high risk of your debt. If you really want to get started, you can start investing in any option based on your current financial capabilities. Compared to more experienced and capable people, they can use debt to increase their wealth. For example, they borrow money from an institution with an interest rate of 15% per annum to invest in a property that can actually earn more than 35% per annum. But for starters, you should not be like them, and you cannot borrow money with 15% interest to buy a bond with a coupon rate of 7.5% per year. 2. The best time to start investing is now. Most people think that they can invest only if they have a lot of cash. Yes, investing is easy when you have a lot of money, but that does not mean that you have little money to invest. It does not matter how much you invest, it does matter how much you earn. You can invest $1 million in an asset that can earn you $150,000 a year, while others invest only $500,000 and earn $150,000 a year. So if you have less money, you should start small, or at least try to learn how to invest more and try to look at the opportunities that lie ahead. You know, when I was young I was very interested in investing, but did not have much money, did not know where to study effectively. At that time, I did not have friends who have clear financial knowledge. Many people who are good drinkers just try to find and save money to invest as desired, but do not dare to take risks and do not see where to invest. Keep reading books and researching myself until one day I met a group of young businessmen at a cafe and tried to make contact with them. Trying to connect with people who are higher than us is not easy because they have no work to do with us, but I still try to learn from them. At that time, I knew what an investment was, but the actual investment techniques, I was completely ignorant of risk analysis, types of profitable assets, how to get dividends, bonds, evaluate profit margins, split capital, reinvest and more. But what made me brighter and more confident was when I asked to listen to one of their investment projects and asked a lot of offers, they almost got bored of me and decided to take a large part of my money. Asked to invest only 1% in that project, I researched their business history. There is nothing left before deciding, so I try to seize the opportunity to go high with them and walk to the present. The lesson is that even if you do not have a lot of money right now, you can sometimes seize the big opportunities of the future by investing a small amount of your money now. The more you can connect with great people, the more chances you have, and sometimes they show you opportunities easily. 3. Research before investing. Do not invest in areas you never knew existed. The outcome of your investment depends on the actual market changes. So if you do not have a clear grasp of the market or business situation, study it before deciding to invest. Why do you have to do it? The answer is simple. If you have a clear grasp of the situation, you can make all the decisions and make the right decision. 4. Do not use emotions to invest. When investing in stocks, as stock prices plummet, new investors rush to sell, even if the stock is low or high. Some saw the share price plummet for a month, after which the price doubled. Some people invest money to buy land because they see people rushing to buy a lot and believe the information has no clear source. Some people cheat people to invest money because they see a high profit rate or interest. Some people are so desperate to lose money that they immediately run away to sell other assets or borrow more money to continue their business life, refusing to acknowledge the actual results that they need to learn more before coming again. In short, investing requires basic techniques and intelligence, not emotion. 5. Do not try to invest to get rich too fast. There is a general investment rule: if you want to make more and faster profits, you must dare to take higher risks. Everyone wants to get rich quick, but not everyone can get rich easily. Real investors look at the results for a long time, so they can control their emotions well when the market fluctuates rapidly. You should have a clear investment goal, know how to do it, go through what stages and know at what age you have enough wealth to get what you want and know how to use the rest of your life. 6. Do not try to invest in a cramped market. Growing profits from saturated markets is not a good prospect. You should allocate some money to invest in the sector for the future. Obviously, if you buy shares of companies like Facebook, Apple, or Amazon right now, the profit margins are low and very expensive, but if you invest in those companies when it first started, you can now make thousands of % profit. Currently, the areas the world is looking at include automotive, waste processing, aerospace, IoT, AI, fintech, and there are many other types of businesses and innovations that you can learn more. Yes. 7. Monitor property balance on a regular basis. Do you now know how much total wealth you have? The average person never monitors their total asset balance, but for investors, it does. Most investors have a financial assistant, or at least a personal accountant, who records and reports financial statements to them. Tracking your wealth balance can help you think of many ways to reach your financial goals faster.